welcome to ICICI Direct. Adani Enterprise, a flagship company of Gautam Adani-led conglomerate Adani Group, began a record secondary share sale for retail investors today. The follow-on public offer, FPO of Adani Enterprise, is the largest ever in the history of India, aiming to raise rupees 20,000 crores. The FPO that opened today will be open for public subscription up until the 31st of Jan 2023. The price band of the Adani Enterprise FPO has been fixed at 3,012 rupees to 3,276 per equity. It may be noted that Adani Enterprise has already raised nearly 6,000 crores from anchor investors ahead of the FPO opening today. Joining us today on ICICI Direct is Group CFO Jukshinder Singh. Mr. Singh, thanks for joining us today. Adani Enterprise is the biggest headline in today's newspapers, social media, and of course, the internet at large. Mr. Singh, can you share with us where the FPO proceeds will be used? We're talking about 20,000 crore rupees here. I do understand partially this will be used for debt repayments, but can you also break that down for us across subsidiaries and how much across each subsidiary, and what amount of debt would you specifically pay back?
Thank you so much. The proceeds, the 20,000 crore is not the straight proceed. It's a partially paid, 50%, and then most likely 25 as we flagged to the regulators. Okay. So it's not all of the cash is not required straight away, and therefore it is based on the capital expenditure and the capital investment plans of Adani Enterprise subsidiaries. Adani Enterprise itself is not raising this capital for Adani Enterprise as a standalone entity. It's for the purposes of roads, airports, and our green hydrogen investments that Adani Enterprise is currently incubating within Adani Enterprise. And about 25% of the proceeds are for general corporate purposes, which go into development of, like, a lot of our platform sits on very large, they are large in terms of number of people who use our platform. For example, airports, passengers themselves are 80 million and non-passengers nearly 200 million. So for that, you need appropriate digital service platform as well. So a lot of corporate expense goes into development of that background work for these companies to come on the market. So majority of the proceeds are for capital and capital expenses purposes. Some, there are shareholder loans that have been provided to these entities. They will be returned back to Adani Enterprise. And so the overall debt reduction would happen on the subsidiaries' balance sheets.
Okay. And which subsidiary is going to be picking up most of these proceeds? You mentioned airports, defense, roads, all
yes.
of these. I don't understand
how much
per year.
Yes. So this is just basically Adani Enterprise being ready for the next 3 years to execute on its growth plans, and also to appropriately have each of those businesses in a manner that it allows each of those businesses to function as they need to function. So they are getting into a mature stage. So we need to make sure that from a maturity point of view, they are correctly structured from capital point of view.
Mr. Singh, that brings me to the next question. Most of these subsidiaries that are housed under AEL are still not self-sufficient. How will this work out over the next couple of years? Will they continue to remain dependent on Adani Enterprise, or can we anticipate maybe a listing for the smaller subsidiaries, which is what the company has done over the last decade, right? They start by housing companies under AEL, then of course a listing takes place a few years into that. So how long do you anticipate from now until self-sufficiency and then of course listing for these entities?
In self-sufficiency, there are two parts to it. One is that, are the elements that are operating today cash flow positive? The answer to that is that the integrated manufacturing unit of Adani Green Hydrogen is already cash flow positive.
Okay.
The Mile Airport, which is Mumbai Airport, and other, they are EBITDA positive, the airport business already. Okay. The road business, operating business, EBITDA positive. The operating element of data center also positive. So the operating elements are already cash flow positive. Wilmar, that is the other entity there, is already it's already listed as well, but it's owned by Adani Enterprise 44%. It's obviously significantly cash flow positive, and our mining services and metals business is massively cash flow positive. So the second part of the sufficiency comes from the fact that these are growing rapidly. There's a ramp up to growth. For that growth, we have to put in extra capital. So, for example, in data center business, the growth requires that, and it's full service data center business. So we already have a partner, Edge Connects of US, 50-50. So they put 50% of equity, AEL will put 50%. So similarly, in Adani green hydrogen business, for the capital purposes, we have MOU with Total, which will finalize shortly, and so that will convert to Total having 25% of their business. So there's a second element of sufficiency. Your question is that the capital will continue to go into these businesses and will go for next 2 to 3 years, and then they will be ready. From a cash flow perspective, in fact, these businesses already contribute some cash flow of their operating business to themselves.
Okay.
So the manufacturing business, excess cash flow goes into the manufacturing integrated system for green hydrogen. For airports, it goes back into the airport business. So and so forth. So it's a very different model. There's no speculative. These are all infra utility type businesses. So some of the day they operate, they produce cash flow.
Right. So that comes to my next question then. As of March 2022, cash flow was about 1,400 crores. While the net debt on the books was 40,000 crores, which makes me come to the point that most of the expansion undertaken by the group is backed by a very large debt splurge. What is the rationale behind this? I mean, not too much of equity dilution has also gone into fund expansion, right? Any specific reason why it's debt and not cash flow utility or equity dilution from the promoters?
Yes. So see, what you refer to 40,000 of this, nearly 7,000 crore is simply promoters' cash. Because we already own a very large percentage, we can't convert to equity because then we'll go above 75%. So first is it's not all third-party debt. So second is it's not AEL's debt. For example, nearly 8,000 crore to 10,000 crore is airport business's debt. So airport business itself is cash flow positive. So it's not AEL's debt. Then, for example, nearly 6,000 crore is the trading book. So AEL has a trading business called Integrated Resource Management. Against that 5,000, 6,000 crore, it has the right sale contracts. So NTPC, etc., who are the buyers. So that is just so for argument's sake, a thought experiment, trading book goes to zero. So 6,000 crore of debt will also go to zero because the whole trading book is just is a trading funding against the purchase. So then you have construction debt, say in roads, but for that road business has its own contract with NHAI. So what happens is that what you are seeing is that individual entities have debt. AEL has very little debt on its own. So AEL's cash flow, as you say, EBITDA is about just about 2,000 crore, just over 2,000 crore actually last year. So it itself has. In that sense, debt which is just about 2 times its EBITDA. Okay, so for example, interest of AEL as a standalone incubator is around 300 odd crore, and EBITDA is well over 2,000.
Right. So just moving on from there, Mr. Singh, also in the last couple of years, the group has ventured into many small businesses, right? What is the rationale behind this?
See, broadly, when we look at group, so I'm assuming you're referring to Adani portfolio companies.
Yes, I am.
So in Adani portfolio, our core is the infra and utility portfolio. So in the infra, we have transport and logistics and utility. So Adani Ports in transport logistics, listed company, Adani Green, Adani Power, Adani Transmission, and Adani Total Gas on the utility side. And now if you see in Adani Enterprise, as we just discussed, airport and roads are on transport logistics. Right. Hydrogen and data center is on the utilities. So our core is just the utilities, even in the incubating businesses. Now, alongside the infrastructure, there are certain businesses that use infra and power a lot. So, for example, cement, which we bought from wholesale, it is a big user of logistics and power. So it's an adjacent business to us. So it's like copper. It's a big user of power and big user of luxury services. So, and that's Adani Transmission and Adani Power and Adani Green Energy can supply the power on arm's length market basis. So it gives us that advantage to have adjacent business model. So if you look at our model, infra and the adjacent business model account for about 95% of our M&A in the last 9 years.
Okay.
So other things we do very small, very little. So they are very, very small in size, and they have very limited impact on our overall portfolio EBITDA. But yes, there are other things which are, which progressively the group looks at, or businesses in the group look at, and then that number is large. So 17 of those M&As, for example, in the last 9 years, but the value is very small.
So what is the rationale then, Mr. Singh? Because we've had NDTV that was bought by the group recently. There's an IPL women's team that has also been picked up by the company. While they are currently small in value, is the idea to scale this up to a significant level going ahead? Do you choose to be a diversified entity 5 to 10 years from now? Or the idea will be to concentrate on 3 core businesses and everything else then becomes the tail?
No, so for us, the core is infra and the adjacent business. So that's about 95% of what we do. Yeah. Now, if you raise the question of Adani Sports Line. Now, yeah. Adani Sports Line does its own thing. Like they organize the marathon. They have IPL teams in Middle East, etc. They have the women's IPL team. Women particularly important because they want. There's an objective in the group to promote women, sport, women in business, women in entrepreneurship. So that is a continuing effort in terms of the deployment of excess shareholder cash in the relevance. So it's again, when you look at the scale of it, so say NDTV, we as a group, we have very large corporate communication requirements. So it's and overall, if you look at the purchase size, 600 odd crores. So is it something that we want to be in media? No, our objective in that case is that we can, like say, for example, Jeff Bezos acquiring Washington Post. It allows that Washington Post to function as independent. Now it's got secured shareholder function as independent. Similarly, with NDTV now, they have a secured shareholder, and it will continue as an independent media, and it allows them to flourish. So our objective also is that tomorrow, like today in India, people quote Washington Post. We are hoping that we bring credibility to Indian media, that tomorrow in US somebody quotes NDTV. And we can offer that independence, we can offer that provision, and it becomes with small investment, but a significant addition to the Indian landscape and value to India.
Right. Mr. Singh, talking about the infra business, which you've discussed as well with me in this conversation, if you look at the industry, it's a low valuation business. But if you look at the valuation of Adani, that is clearly an aberration where you're trading at a massive premium. What do you attribute that to? And do you think that's sustainable going ahead, given the dynamics of the industry, really?
See, valuation is something different from as a senior person for talk specifically about a share value. But let's address the question of infra and utilities. Okay, what part that where we look at it, we assume certain things. So infra and utilities are a stable, low growth model in the OECD. Because when you go there in Europe or in America or in Australia, the basic infrastructure is already there. So if you go to Australia, so Melbourne to Brisbane, 2,000 kilometer expressway is there. Okay, India doesn't have, we are still building Delhi to Mumbai. Okay, let alone other parts. So for us, infra is growth story. Yeah. So if you look at the growth story companies, okay, their multiples are in line with ours. Now we just happen to be in infra sector. Okay, but if you look at any sector that has a significant growth potential, okay, high double digits or even above 20% growth potential, they trade at multiples consistent with ours only. So you take a sector that like us, we have grown 23% in the last 9 years, year on year. Now you take a sector that grows 23% and look at their multiples.
International.
Internationally, then you are then get the comparison. Now, eventually what will happen is in 20, 30 years time, when all of the infra is built, and then we are just adding and improving and this and that, then infra growth will come in line with GDP or slightly closer to, maybe even under GDP, but closer to GDP. Today, our GDP is at about 6.5%. Infra is at 15, 16, 18% on average. We are growing a little bit faster because we can deploy a lot of cash. But I think that's the context you need to look at.
Okay, so it's more comparing itself to international peers with regard to growth.
And plus peers that grow fast.
Right. I know this might not be a relevant question for you, but I'm still going to take it because this would be important to our viewers. In the past 5 years, the stock has rallied 1,500%. Do you think the rally is over for shareholders, or do you think there could be further upside, especially keeping in mind the valuations? I know that they're comparable, but I mean, 300 plus PE is what the stock currently trades at. Just want to get a sense. Further upside, still a long road to go from here?
See, Adani Enterprise is not a PE stock. It's an incubator. Okay, it has, because of itself, its job is incubation.
Right.
So its value comes from the value it has in it.
Yeah.
Okay, because you are looking at the value the Adani Enterprise shareholders get is they get the value of the company that, for example, if you are, say, Adani Enterprise shareholder in 2014, okay, or 2013, you would have got Adani Ports, Adani Power, Adani Transmission, Adani Green, Adani Total Gas. Now people say, okay, well, value. But if you now look at the cash those businesses generate. So I'll give an example. Adani Ports, close to 2 billion EBITDA cash flow. Adani Green, touching nearly billion EBITDA. Adani Transmission, when it completes its current under construction project, will touch a billion EBITDA. Okay. Then Adani Total Gas business, nearly 300 million EBITDA. So when you look at cash these businesses generate, okay, the same is for the airports, for the green hydrogen, for roads, and for data center business. So the value will accrue to Adani shareholders because they will get these assets handed to them, like we did past the demerger. So they will become owner of the airport business, owner of the greens business. So that is a capital value that will accrue to them. Now these businesses, these four businesses, when we execute what we are looking at execution, which is execution risk remains, which we are mindful of and we focus a lot of our attention on, execution operational risk. We execute these projects, then these projects will actually add more EBITDA than we totally have in the portfolio today.
Okay.
Yeah. So it's a massive step change.
Together.
Yeah.
Great, Mr. Singh. Great talking to you today. Good luck with the FPO.
Thank you.
Hopefully you make those numbers as
expected.
Thank you. And good luck. Thank you so much for joining us on the show.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.